Hey guys, in a world of trading, if you look at YouTube videos, you be disillusioned actually because most of them are selling a course or talking about day trading, whatever. And the reality is, a chart's one thing in the market, but there's a lot of things that come into trading outside of just looking at a chart. A chart's not foolproof. They're flawed in nature. They're misleading. There's all types of things that will happen with institutional trading that'll mislead you when you look at a chart. So keep that in mind. They trigger stop losses and limit orders intentionally to crush you. So I'm not a day trader. I'm a trader. I trade almost every day, but I'm not a day trader because the trades I trade sometimes I keep them for a while, I keep them for weeks at a time. Sometimes they're underwater for a length of time. But generally speaking, I'm pretty successful on my trading. At least I would say the last year, especially, I've been flowing pretty good for the most part. But I'm not winning at all cases. In some cases, I get a sign on a stock like I do cash cured puts, and I get a sign on a stock that is currently in a downward trend. Like, for example, I have HTGC 200 shares and it's underwater, but it pays a nice fat dividend. So I'm holding it for now. At some point, if it's a laggard and I get to break even with dividends counting, I'll probably drop it for some other opportunity. But if you look at it, most of these people, they're either selling a course or they're day trading or they're giving their opinions. And yeah, I know I'm giving an opinion too, but the reality is you really can't learn off the majority of what you see on YouTube. So I don't know if I'm able to fix it at all. I do like some of the dividend channels. I will say that some of the dividend channels. I do watch Matt Giannano, which is right here, top three trades. Uh, he's had an okay track record, not horrible. He's become a better trader actually over the last couple of years. Anyway, with that being said, a lot of these videos also cause you to form an opinion. So you want to be careful about forming opinions about direction in the market. Instead, you want to pick up opportunities, and it's simple to me. You could just look at a good stock. For example, the majority of the Mag 7 old good stocks, and you just pull up a chart. Now, if I wanted to look at NVIDIA, for example, is this a buying opportunity? Well, for me, not necessarily because the RSI, which is down in here, is inflecting downward. That was just from Friday. But the MACD still looks bullish. And you do have the earnings catalyst coming on, so there could be a bounce in the next week. But it's elevated on the RSI. So is this a buying opportunity? Not necessarily. A buying opportunity to me is like if you're heavily discounted and the macro thesis for NVIDIA has not changed. For example, their sales are still ramping up and they expect to beat revenue or anything like that. Now, that's still a buying opportunity, obviously, going forward if they give good guidance around earnings. I never trade stocks around earnings, by the way. I leave them alone at that point. Now, Amazon to me a couple of weeks ago was obviously a buying opportunity. It was flatlining on its RSI, and you see the chart. It was just trading sideways forever, and it was due for a breakout. And then you had that crossover, the 9 over the 21 EMA, and it broke to the upside, and it's never looked back. It started to chop now to the downside a little bit, so that it could be an opportunity in the future. So that's how I look at good companies. If they're beaten down on their RSI like it was way back here, back in February, it was really beaten down, and for no other reason than the market pulling back, and it's a good company with expected catalyst to pull it higher, then it's a trade opportunity. I don't care what people are saying at the time because you know that this company figures it out at some point in time. That's what I mean by trading good companies. You can't really go wrong when they're discounted heavily. So I use proxies too. For example, for Mag 7, if I don't want to pick an individual stock, I go with MAGS, which is an exchange traded fund that basically does derivatives rather it doesn't do derivatives. It actually holds all the Mag 7, but in a synthetic kind of form. It do swaps and through swaps and stuff like that. That's how it holds the Mag 7. So I wasn't overly aggressive on it, but I was trading it during a couple of the pullbacks we had, especially that deaf and gloom that was surrounding the Mag 7 back in here. Back in April, I was trading it heavily there. And the reason I like trading it, well, I don't have to pick a particular stock. I picked the Mag 7. The other reason why is you look at the volume on it for the day, it was at 3.6 million shares traded. It's got over 4 billion in assets, so that means the liquidity is going to be awesome, and especially probably for options. So if you look at the options, say for example, going out almost 30 days, look at the liquidity on that. You got pretty decent number of open interest and volume. So if a trade has open interest and volume on it, and the bid and ask ain't so horrible. And what I mean by the bid and ask, if you look at the tables, the bid is the minimum price, the ask is the high price, and then you see the last price, and that was the last price that option, like the 69 strike, for example, got filled at. And if you're looking at an option table, keep in mind it represents 100 shares for each option contract you do. So you multiply that figure, that 1.60, multiply that by 100. That's 160 bucks on that option. Now, I was trading mags when it was pulled back extreme. I was trading it back when the Mag 7 was getting all the doom and gloom news. And I'm like, well, that's a no-brainer. Look at the RSI. It's oversold. The Mag 7 ain't going to stay down forever, and it was obvious that it recovered massively since then. And I don't wait for EMAs. I look for oversold readings on good stocks. And so the Mag 7, by and large, are good stocks. They're full of money. I know they're spending a lot on CapEx, but they're still capital intensive, generating revenue like crazy. So that's what I trade primarily. But then I look for catalysts in the market too. So I've found a few companies or even exchange traded funds that do options like covered call type stuff that have done really well, and I've added them to my buy list during pullbacks or corrections. Now, I've been trading DRAM recently, and with DRAM, I was premature. I got in actually at 37.23 a share for 100 shares, but I immediately sold a covered call, which turned out to be a mistake because DRAM just kept going higher. Right now, it's getting to a point where it's going to present an opportunity, hopefully, if we get a continued pullback. Because the story of the macro thesis for DRAM has not changed. So if we get a pullback, a correction anytime soon on DRAM, and we had a one-day pullback on Friday, which is just relative to different scares in the market like inflation concerns and rising yields, and the fact that you had OPEX expirations on Friday. So it pulled back on Friday. It might get a bounce in the next week, but I'm not trading it currently because if you look at the RSI, it's starting to inflect downward. You see it, the MACD down here is starting to inflect downward also, starting to curl over a little bit. So what I'm looking for is a pullback closer to my average, and I'll look at the chart at that point because I know the macro thesis, at least for DRAM and the chips the chip companies that it holds, has not changed at all. You understand what I'm saying? Basically, going in through to probably 2027 at a minimum, these companies that DRAM, which is an exchange traded fund that holds Korean and high bandwidth semiconductor companies like Micron, for example, these companies still have a catalyst to continue to go, but they're probably due for a whole pullback. So if they do get a pullback, it'll be a trading opportunity, obviously, because the macro thesis for why these companies are doing well has not changed. There's still a bottleneck happening within the high bandwidth memory chip companies. So DRAM is tradable. And the other reason why it's tradable, it's one of the fastest growing ETFs. If we look at the assets under management, let's pull it up again. Sorry about that. If you look at that volume for the day, 35 million shares traded. This thing just came out April 1st of 2026. And it already has 9.69 billion assets under management. It's growing exponentially, and there's a macro thesis for why it's going to continue going higher despite any pullbacks and corrections in the intermediary stage. And if you look at the options on it, this option for 22nd May 26, if you're going to sell one at the money or near at the money, the 51 strike was paying over $200. If you go out on this all the way to the end of the year, you can see there's still liquidity. There's open interest and volume on the option tables, and that those premiums are quite juicy. So I made $1,700, I think it was, on my covered calls. I rode out all the way to 2028, I think it was, and that's what I plan to do is keep on rolling it out. Now, if it gets below my cost basis, I plan to buy more of DRAM because the catalyst has not changed for that sector of the market. The other thing I was watching, and I should have been more aggressive, I sold puts on it, was Brun, BRUN. It's a new semiconductor company. It had the catalyst of the fact that it was an NVIDIA. You got some kind of NVIDIA chosen award thing on it. It's not got an agreement with NVIDIA as far as I know, but they were their process was selected by NVIDIA as one of the type of companies that they prefer. Some of that nature. I don't really understand. I really don't know nothing about the company outside of the fact that the financials do not look terrible. It got a strong buy recommendation. It just recently IPO'd. They don't carry much in the way of debt either. If you look at that balance sheet, they got almost no debt at all. Cash flows are still negative, so it's a risk. So I consider this a high beta because it's not exactly the most profitable company out there. But if you look at the performance since it IPO'd, it's been stellar. Am I trading now? I traded last week back when it pulled back under $20 a share, and I traded options by selling puts. And instead, I should have bought a call option, obviously, because this thing has been exponential. But I was erring on the side of caution, so I didn't go heavily into it. So this is one of the companies I've been watching for the catalyst of the fact it's like a data center company, and these data center companies have been ripping lately. So on any pullback where this thing gets oversold outside of, if it isn't a macro thesis going against it, I'll probably trade in again if it pulls back down to oversold readings. Right now, I'm just resting on cash secured puts. But I've been targeting certain covered call funds during pullbacks like T-SPY, which now has some optionality. And I've been looking at Oval because Oval has been one of the top performers in the market as far as these covered call funds. It's done really well compared to other funds. And I'm looking at a leverage play with XQQI from Neos as opposed to maybe just trading straight up covered call funds. I might go with a boosted fund in the future during corrections because FQQI has done well. But in that note being said, TDAC has done well too. So I like TDAC. And the only yield max fund I have is Soxy, which has performed really well. They target a 12% yield from their option strategy, and they've been doing better than most anything that yield max has. And naturally, you have the catalyst. The semiconductors haven't gone up, so I bought that early. I wasn't aggressive enough. I only bought 10 shares. I wish I had loaded up now, but I was testing the waters a little bit. So any significant pullbacks in Soxy, unless the macro thesis has changed for semiconductors, which I don't foresee that changing until probably 2028, but I do anticipate dips and corrections in between. Well, any such catalyst as a correction, I'm going to be buying all these funds, and I'll be trading heavily into DRAM. DRAM is my current choice for optionality and the fact you got a bottleneck in the high bandwidth semiconductor sector. So like I've been saying, guys, when I'll talk about my trades, I'll show you trades that I'm into and what options I've been looking at. I bought DRAM at 37.23 a share for 100 shares, and I did call options, and my timing sucked. My timing was okay by luck for buying into it when I bought it because it just went up higher and higher, but I sold a cover call way too soon as a hedge because I was expecting a pullback because it was already back when it was in the 38 range. It was already kind of extremely elevated, but looking at the EMA for the 9-day EMA, it really wasn't that elevated. If you know anything about looking at EMAs, when you get a big gap above that 9-day EMA, you might want to take profit. But really, back when I bought it, it wasn't overly extended yet. To be honest, it was just riding it up, and the catalyst was for semiconductor chips to go higher. So anyway, guys, that's what I've been trading. I'm big on DRAM still. I'm looking for a deeper pullback before I get back in on it. I'll be probably be selling out of the money puts, maybe buying call option, using the puts to finance a call option. And when I trade, I'm not looking for day trades. Sometimes stuff that I trade turns into a day trade or maybe an overnight trade. I was looking for opportunities. I'm looking for arbitrage opportunities and what really has the optionality and the flow and what's tied into the better companies of the world. And this is why I look at stuff like MAGs, for example, like I discussed previously, because it holds the MAG 7. So a breakdown in MAGs, like it back in April, I traded. Obviously, you can trade the best companies in the world when they're deeply sold off. Anyway, guys, so a lot of people on YouTube are just pumping courses. There's very few of them that ever talk about anything else but pumping a course or day trading. And I don't think you should look at the market that way, because technicals are just one side of the market. And if you're just basing your trading on technicals alone, you could be crushed. You have to look at different catalysts, like what I discussed about DRAM, as far as the catalyst of there being a bottleneck with a lack of supply of high bandwidth semiconductors. And I believe one of the companies, I forget which one it is, that DRAM holds is going through some labor negotiations. It might have been SK Hynix, I forget which, or Samsung. But one of them has gone through some a potential shutdown on labor if they strike, and if that happens, well, then your bottleneck just increases, and so DRAM will be an opportunity all the way through 2027 at a minimum, unless these companies no longer need high bandwidth semiconductors. So you got to follow the tech a little bit too to know what kind of catalysts are coming out. Anyway, guys, that's how I trade. I look for liquidity, I look for performance, and I use, for example, I use stock analysis, the app. I subscribe to it, and I use that for my comparison tables and stuff to look up stuff. So if I want to look up, for example, TDAC and compare it to something else, I got to pull up TDAC, and I got to do a compare table on it, and I'll pull up QQQI, which used to be and still is one of my favorite ETS because it's got a great liquidity. But if you look at the 1 month on TDAC, it's been outperforming against QQQI. So I look for that too. I like to see what happens with the stock's performance during a correction, how it comes back. I hit the wrong button there. All right, guys, I'm going to cut out here. This isn't advice. This is how I learned to trade over time. You guys take care. Bye.